look at the tools behind our 3-point playbook portfolio. It's a portfolio that this morning was standing at, and I'm looking up at my screen here, 31.3%, and that's since January 1st. One of the guys who is the key to the success behind that amazing number, Liam Flavell, is with me, and I'm so glad because then I have somebody to ask questions of.
And you not that buffoon earlier.
No, we're not going to talk about Hans Henrik Nielsen here on this show. He, of course, was the guy who got the questions on the Danish webinar that we had here a little over an hour ago. And Hans Henrik has been in the market since 1987. Liam, your background is that you come from fintech, and you have been in stocks for many years as well. And you will be on hand for the next 45 minutes. I'll do the asking, but you can ask your question as well if you write us at FOMO@mystockscanner.com. That's FOMO, fear of missing out, at mystockscanner.com. Then I'll pass the question on to Liam, and we'll try to get some of them. But at first, Liam, why did you guys build mystockscanner.com, and what is the tool that is the 3-point playbook?
Well, we built the system because Hans and I, we've been investing. Hans has been investing for longer than me, but I'm probably in the 90s, mid 90s, something like that. And we've used all sorts of systems out there, and we like different bits of individual systems. So we looked at it when we started working together. It feels like about 20 years ago, but it's only about 6 or 7 years ago. And we said, well, why don't we just build a platform that works for us with all of our favorite tools in it? And that's where MyStockScanner was born. The 3-point playbook was a slightly newer side of things. It's a slightly newer idea. It takes all of the learning that we've had. So Hans has traditionally been a technical analyst. So he's looked at the pricing of stocks and the patterns that stocks make on the charts. And he's really sort of not ignored, but not taken to, used full advantage of the information on the fundamentals out there, which is the accounting side of things. And that's where I come from. I crunch the numbers. I look at whether you can get an edge from the accounting data that comes out of these companies. So when we started working together, we suddenly started realizing, well, actually, he's not quite as ridiculous as he looks sometimes, and actually he's got some good ideas, and the technical side of things works. But also he was saying that he was looking at the same thing for me. So that's where the playbook came in, to marry those two together in a very simple framework that anyone can follow.
And I know that you call it simple. Again, I know there's a lot of people who are beginners who maybe don't have the big experience in the playbook, and neither the website as well. And we're going to take it slow here tonight. We're going to do it one step at a time. And as said, questions are welcome. And we're going to break the numbers, and we're going to run some stocks through the 3-point playbook that we just have been talking about here. And you'll get to see both stocks that we have been in and stocks that we just bought. And all the stocks we look at, they go through the 3 simple questions that we ask of all stocks, and that guides our picks. And is it a quality company? Does it have an upside? And is now the right time to buy? That's how you can save time, you can make smarter choices, and hopefully you can grow your money and sleep peaceful at night. And you jump straight into it, and we should do that. You can take it away from here in that sense that Liam, let's get into the website, because when you come to the website the first time, mystockscanner.com, you might get a little overwhelmed and go, there's no way I can control this. There's no way that I can find what I need. This is what greets you when you come in. Take us through it. Give us an introduction to the website.
Okay, it's the first thing that you come into. We start from the playbook point of view, and one of the services we offer pretty much everyone on the system to one extent or another is giving them information. So where Hans and I do an awful lot, and you yourself, Jesper, do a huge amount of work, is in getting what's happening in the macro environment, in the countries, what's happening with interest rates and things like that. They're things that people as new investors don't necessarily have the experience or the time to get into, or the knowledge to get into. So we sort of look at that for you. So every day there's something called a market scan, which Hans Henrik writes, which is looking at the bigger picture. And then we use that bigger picture to say, okay, so if interest rates are going to go up, Who does that benefit? Does it benefit banks? Yes. So probably financials are the things that we're going to look at. So in the next couple of weeks, couple of months, we're going to focus on there. So that's what we give at a very high level every day, information on what's happening in the market and what's causing some of these big falls. You can see we talked yesterday about Novo Nordisk and why that fell so much. So that's the very first step that we give, and that's what we show people on the system here.
And what you have here right here is, of course, as I said, it can be overwhelming, but this is basically the greeting side. That's where what meets you first, and you can see a sort of a little overview of what's on the side. And there is a forum. There's always on the left-hand side. That's where if you look at your screen, that's where you navigate from to get to the different sites. This is the forum. This is where you find the articles. This is where you find stock of the day. This is where you find our show that's on Monday, Wednesday, and Fridays. And then this is also the place that you start looking from. You might go to watch list, you might go to portfolio, screeners, what have you.
Yeah.
And this is also where you seek from, that you take a look at the stocks.
Yeah, so watch list very quickly. We won't go into too much detail here. It's all in a lot of courses, which you can actually find in our Learn section. You can go into the help videos. We've got a few courses on basic investing, on technical analysis, swing trading, and also on our 3-point playbook here. The 3-point playbook course currently is only in Danish, but we're putting it into a proper language, sort of properly, very, very soon. Sorry, I couldn't resist that. Yes,
no,
yes,
I know. We'll peck you down a little bit. So don't worry.
So we got the Learn section there, which is a great place to start off with. But from a exploration point of view, we have a number of watch lists, which we'll touch on sort of very quickly tonight. We've got some screeners, which allow you to screen across our entire database of 100,000 odd stocks. And we've also got portfolios where you can actually either record your own transactions in your own portfolio, or you can follow our 3-point playbook portfolio, which is what we're here today to talk about.
And that 3-point playbook portfolio up by 31.3%. We had a viewer in the Danish side of the webinar that said that his was up 32.3 with the help of My Stock Scanner. So one thing is, it's not a competition. Let's not go there. It's not about, but it's about making sound and good decisions in your investment. And this is the portfolio. This is what you see. We're not going to show the entire portfolio. We're going to show you some stocks we've been in, and at the end of the show, we're going to show you the newest stock that we bought, and we're going to go through it in analysis. But take us through what you show here on the portfolio page.
On the portfolio, we've effectively got a net asset value. Is how we're doing as a whole portfolio. So we're currently around, what are we, 50%, 51% invested. You can see it there, and we're up 31%. Since we started, so 31.34, and you can see here this grey line is the benchmark, which is the S&P 500, which is in euros. So it's taken a bit of a beating this year because euros have gone down. So the dollar has taken quite a dive, and the euros has strengthened. So you can see here on a euro basis, the S&P 500 is only up about 3.6%. In real life, it's 15%. But if we have our cash in euros, our assets in euros, then actually, and we'd invested in the S&P 500, we'd only be up 3.5% so far because of the currency fluctuations. So that's an important thing to take into account. When we look at our actual performance, and we'll show you everything that we do to make our decisions on what stocks to go into, you can see here that our average position makes us almost 10%. And of those, the winners make us 25% on average, and the losers are around 7%. So, go on.
And what you also can see is a little bit of the diversity and understood in the different sectors. That's the little cake here on the left-hand side, how you slice it, and you can tell what industries that we're in currently.
Yeah, these are the sectors, and then you can actually drill down into the stocks on the next page. We won't show everyone off what we're into at the moment. That's specifically for members, but you get a peek of it when you're a trial member as well. So that's.
And one of the things I know that's the pride of you is also the drawdown. And for new members, explain, Liam, what the drawdown is, because that's basically what keeps you up at night, is how much you lose.
Yeah, the drawdown. Everyone says I can pretty much trade through everything. Most people can't. So if you look here, this red line here shows you the drawdown of the system. And the worst case scenario that we've had this year is we were down 7%. From the peak of the portfolio. At the moment, the market's dropped 8%. Probably come up a bit since yesterday, but we only dropped 2%. Because we're, our stocks are a little bit better, but also we're 50% in the market. And what we also often find with the 3-point playbook is that it actually starts showing us exit signals for individual positions just before market turbulence hits. So we tend to see sort of quite a big move downwards in the number of stocks that we're holding, and then the crap hits the fan, and you think, that's why sort of all the stocks have started to go down a bit. So it's an interesting correlation there.
But let's get to. I'm almost going to say let's give it a spin. Let's see what the 3-point playbook is all about, in that sense that we need to take specific stocks, and why not go to this guy, the biggest company in the world. If you look at market cap, it's dropped a little bit today, but I still think it's the biggest in the world, isn't it?
It is the biggest for now. Yes.
But it's not sure that it stays that way. Who knows?
No, well, we saw that. Look at Nvidia. Novo Nordisk. It was the highest company, biggest company in Europe for quite a while, and it's dropped quite precipitously. And it was probably in a very similar position. But if we look at Nvidia, you can see here, I just hit the search for a ticker here and just put in the symbol search.
You need to share the screen so we can get to see it, all of us, because then we can see what goes on at your screen. It might be that I have knocked your screen out.
I think that's what it is. We'll bear that in mind as we go forward. So I've just searched for Nvidia. It's come up as the top of the list here. There are lots of Nvidias out there because they're often companies are often in various different exchanges around the world, so they get access to liquidity across the global exchange network. So what we come into is our playbook page to start off. There are lots of other tabs up here, and we'll go through a few of them as we go in, but you can find more information on the system as to what those tabs are. But effectively, the first point of the playbook page is actually just a company description. It tells you what the company does. Most people who haven't been living under a rock for the last 5 years probably know what Nvidia does and what they stand for. But yeah, they're an IT company. And then once we're through the description, we come to point one, first point of the playbook. The first point of the playbook is, and the first question we ask ourselves is this a quality company? And the reason we ask whether it's a quality company or not is because it's fairly obvious. We don't want to hold rubbish in our portfolio, because not only do we want quality, if we're going to buy anything, we want to buy as high a quality as we want. Quality stocks tend not to drop as much in the bad times if you're holding them as the really crappy stocks out there. So this is why we focus so much initially on whether this is a quality company. The key to this page, once you get used to it, is you can identify within 20 to 30 seconds whether a stock is right for you or not, and whether it's close or at the buy zone that you're looking for. And this is where the first point of the playbook comes in. It's basically colored. So green is good.
And you say that not just because you're Irish. It's basically because it's easier to kind of, it's green, like in traffic you can go. That's it. It's not because you're Irish,
it,
right?
basically.
Yeah,
and
okay, good.
the yellow is sort of stop or wait. It's okay. It's in the neutral, and red is over there. If it's really good, I might have black with a white top on it to signify Guinness. But if we're carrying on that theme. The very first point that we look at, so I tend to look at 3 metrics on here first, and they tell me whether I want to look at the rest of it. The first one is quality score. That's it's out of 100. 100 is the top, so it's not surprising Nvidia is pretty good up here because it's the biggest company, it's got the best results recently, and so on and so on. So quality score, anything more than 60, I'm interested, and I'll look further. Maybe 50 if I'm looking at the if I know a bit more about the company. Maybe if I think, it was a dead loss, but I know it's coming back. But generally 60 is the guideline and more, and anything with 80 or more, I'm absolutely interested. The next thing of the 3 key elements that I look at is earnings per share. And that is basically how much profit the company makes for every share that it's got. So it's simply net profit divided by number of shares in the company. You can see here that a few years ago, Nvidia was making 0.17, so that's 17 cents per share. And in 2 years' time, in 2027, analysts are expecting it to earn 7.42. So this golden area here is the analyst estimates, and this is the last actual that we've got. So Nvidia is not going to surprise anyone. Their sales has been going and their profits have been going through the roof, and that's what we like to see. That there's explosive growth coming forward, and this is what this shows you. The third thing is whether that explosive growth is already priced in, because it might be, Nvidia is hugely expensive and it's not worth buying because it's too overvalued. The PEG ratio is basically whether the higher the number, the more of that growth is already in the share price. So we look for a PEG ratio below 2.5. This is a 0.77. So that's fantastic. So even though we know Nvidia, everyone knows about that, and it's almost a nosebleed territory though when you look at the price charts. This chart, what we're looking at here is there's still room to grow for the price of the stock. Then we can look at some of the other elements down here. We've got the revenue, which is very similar to the earnings per share up here, in similar sort of lines. You've got the health score. That's a fairly old metric, but it's out of 9. It's probably something we might even ditch because it's a bit antiquated, and the newer companies, the way they're structured, the way they're financed, doesn't quite work. It's something called the Petrovsky score, which was written by a professor called Joseph Petrovsky in the 90s. The analyst score here is out of 5, and 4.5 is pretty good out of 5. So most analysts are saying buy. There are some quite famous ones and quite big ones out there now saying, hold on, we need to look at this. The analysts are all expecting good things, and they're actually upgrading the stock over the last 7, 30, and 90 days. The returns on capital, so the returns on capital, returns on equity, returns on invested capital are effectively measures of how efficiently a company uses a dollar of your investment. That's the best way of looking at it. If it's getting more efficient, that means great. It should mean that more profits are easier to generate in the future. So having these companies with either level or increasing returns on equity capital and invested capital is a great thing. Similarly, free cash flow, that's how much cash the company actually generates that can go into the company to either be put into dividends, share buybacks, or just reinvested into the company. Free cash flow is one of the key things we look for in a strong company, and making sure that's growing. And your price to free cash flow, that's the one metric on this whole page that's slightly in the red. And that's basically saying when you divide the price by the free cash flow, then actually it's looking a little bit expensive. So we normally look for about 30, 35 or less.
But I'm turning Irish here because I'm all green as well. I kind of look at this and I kind of go, this should be a stock that we should buy right away. But we stepped out of it, and there's reasons for that, and those come in the next couple of steps that we have here.
We did step out of it, and if I just switch over, so you can see the valuation chart here for the second question, which is the stock undervalued? Is it cheap at the moment? Because we only want to buy cheap stocks. We don't want to buy quality stock that's already had its price rise and there's no more left in the tank. So that's what we look at. And then the third question is it now a good time to buy? What I'll do, I'll switch over to the valuations tab to look at whether the stock is under or overvalued. And what we do is we have basically 3 or 4 different cases. We have a bull case, which is the green line here, which is where I think that's the best case scenario for the stock. That's where if the company executes absolutely perfectly and the investors still love the stock, that's where the price is going to go. The bear case is in the worst case scenario, what's going to happen. So for me, what I've done is I've modeled April. This is the middle of April. So this is after the Trump debacle with the tariffs in April. Everything dropped by about 25% or so, some more. And it bounced back from there. So I'm looking at that thinking, this is pretty much the lowest point over the last few years on the earnings side, on the price side of things, where this line has got to. So actually, that's not a bad place to put my stop, to put my, not my lowest, my low case scenario. The yellow line is where the analysts think it's going to go. We can't move that because they've already got that. And the blue line is our base case. This is the one that we actually expect to happen. So this is where we look. And the rule of thumb for this is effectively what we're doing when we're moving these lines around, when we're moving the blue line up, what we're actually doing is changing the price to earnings figure here. So you can see a figure of 45.18. If I just move it down a bit, that's changed down to 40. Now, the price is basically the earnings per share that we expect in a couple of years multiplied by the price earnings ratio that we want to that we think the investors are going to lap up, are going to buy in a few years. That multiplied together, it gives us 298, and that is where this blue price ends up, 298. So there's no rocket science here at all. All we are literally doing price times, or the earnings per share times the expected PE value, and you've got your magic number of where you think it's going to go.
And when I look to the right-hand side of the screen where your cursor is right now, I of course, we always go for the higher number. I almost see it. I can make 100% over the next 2 years.
You can do, and you may well do, but actually we try and add a dose of realism into here to say, okay, that is the best case scenario. And at the moment, Nvidia is trading at 60 or 45 times their current earnings or last year's earnings. So if we actually plug that one in as a maximum, you can see that the green line comes down slightly and it's a lot closer. So and that number comes down. So the PE ratio, the earnings per share, what we do is we basically say we pretty much trust that yes, the analyst estimates are going to be within the ballpark of where the company is going to come out, and that's because the big banks, big investment companies, have hundreds and thousands of analysts sitting there crunching the numbers, talking to the account managers and finance people and things like that, and coming up with where they think the earnings are going to be. And with Nvidia, we've got something like 30 or 40 different analysts who are all coming up with that number. So this 740, 742 earnings per share estimate is actually an average of all of them. So we're in ballpark figure.
See, now there might be people sitting looking at the screen right now and say, why did you guys sell it? Are you crazy? You gave up on all this profit. You went out of it. Why did
We
we go
did.
out of it?
We went out of it because effectively a couple of weeks ago, I go up to the top, you can see just in the left-hand side, the PE was 68. Now the PE is 61. Within 2 weeks, Nvidia hasn't changed, hasn't become less profitable, hasn't become a less good company. The investors are starting to look at this and say, okay, the PE of 68, we were willing to take that risk on that we might never see any money for effectively about almost 75 years, something like that, out of this and get our money back in that time. We expect bigger growth from that. And at the moment, everyone's questioning whether Nvidia is going to have that growth because they see actually, are people going to be able to afford all the GPUs that Nvidia make? And they say they're estimated to make in 2027. There's big question marks there. And also Google's come out and are starting to sell their processing units to other companies as well. So that suddenly brings an element of competition in here. So all of a sudden, investors within 2 weeks have said, oh, okay, my risk appetite for Nvidia has dropped. And that's one of the reasons why we went out. And you can see that.
Yeah, I was almost going to say, because then there's the third step, and that's the timing in it as well.
Yeah.
And basically, again, when we invest in stocks, we have rules. Those rules we live by. We don't get attached to it. We're not married to Nvidia.
Nope.
So basically, if it doesn't go by the rules, which means that if it drops to some different moving averages, that's when we start to think about selling.
Yeah. So when we look at buying into a stock, we look at a number of areas. So we've already established the stock is a really good quality stock. We've already established that it's value, it's got some value in there because, as you said in the last page in the value tab, in a year's time it could even double. So fantastic company. Why wouldn't we stay in there? And that's because if you look at Novo Nordisk, which we'll look at in a sec, that was a fantastic company and then suddenly halved in value. And that's what we're worried about here. And that's what we protect ourselves against. So what we came in, I think we came in around here, somewhere like this. So what we have is a number of rules that say, from a third point of view, is this the third point is now a good time to get in? And what we look at is a couple of series of moving averages and our own MTI indicator here. Now, the MTI indicator comes in two flavors. It's either red or green. And again, you can, it's the very Irish leprechaun. Green is great. Red, okay, hold on a sec. We need to start thinking about this.
Yeah.
So we've got the weekly series down here, which is slower moving, but gives us a better trend, but gives us a better idea of whether the stock is sort of in it for the long term. You can see that Nvidia was red until the 15th of May, and then it started going up, and the MTI tracks this going through. The daily series is exactly the same set of calculations. It's just quicker, so it moves into red and green more often. And we can see here that when we came into it, I should know actually, it's around here, I believe, on at the end of September, the stock had just gone double green for us. And what it had done, it also come up above its 50-day moving average, which is the green line here. Now, that is basically the average closing price of the stock for the last 50 days, and it's a rolling one. So from here, it's the last 50 days from the 6th of August backwards. From here, it's the last 50 days from 7th of August, and so on. So it's a changing line that gives us a good proxy for whether the stock is in an uptrend or a downtrend. So you can see here, when it breaks the 50, that's when we start thinking, okay, is this now time to go out? Because if this isn't in an uptrend anymore and it can't get above the green line, then actually it's going to carry on going down, because stocks, they can go sideways for a while, but they tend to have more volatility in their ups and downs than just going straight sideways. So we came into it around the end of September, beginning of October, and the stock had just dipped, hit its green sort of 50-day moving average, and then bounced back. And we call that a support point, where the 50-day average, investors are seeing it hit that level and thinking, for me, that's cheap, and I'm going to buy it. So that's basically what a support point is. When it goes under, as it sort of has here, it can then very easily become a resistance point, where investors or traders are coming in, the stock is hitting this green line, and they're selling because they're putting that as that's where their take profit level is, and they're saying that's enough for me, we'll sell, and the price goes down. So that then becomes resistance.
And
You can
one of the things about this investing, and one thing is that you have your strategy and you stick to it, even though that it looks
yeah,
fantastic and stuff like that. You stick to the strategy you have the day you buy it, and you don't change that. And then also, you can always get on board again. If you
yeah.
sell it, you can get back on board. You might not lose more than 1 or 2%, depending on how much a dip and buy it goes. And sometimes, of course, you miss the train, but there's always a new train coming.
There are so many trains, and we've now got a list of, it's somewhere around 300 stocks that we track actively every day to see whether we go into them or not. We've got some new tools coming out that actually are probably going to make our life even more difficult, because we've suddenly got access to a huge amount more stocks that are great stocks that we can go into. So, but you can see here that we came out of Nvidia after this. It shot up on its results and then came straight back down again, and that's when we came out around here, when it sort of didn't look like it was going to go anywhere else. If it jumps up above its 50, what tends to happen with these things, it will jump up above its 50, come back down, test it, and then go back up again. That's the kind of thing that we like to see, to say, okay, that 50 days now become support again, therefore we're comfortable with going into it and trying to catch some of this upside over here, and get to that 116% or whatever the level sort of you think it's going to be up there.
And when you say you don't mean me, you just mean the
But
buyer themselves.
this is it. We've had so many new investors come in. And our client base covers a lot of different sort of levels, and it's always difficult on these sort of webinars where to pitch this sort of thing, because some of the more advanced users that we have, advanced traders, they've been trading for years. They use the 3-point play. They use some of the ideas behind the 3-point playbook. They like the quality aspect. They like the value chart, because actually once you get into this, you get hooked, and it's very difficult to trade without it, because suddenly you're thinking, well, I want to know whether it's cheap or not, or whether it's expensive, and the only way I can do that is either doing it myself in Excel or doing it on my stock scanner. So that's great. So we have the advanced guys that really sort of use the individual tools to fit their own arsenal, as it were. Then we have the beginner guys that come in. We've got some that we've talked to and interviewed and coached along the way as time's gone by. They're up, as we saw earlier on with Jens, 32%. Fantastic. He's not the only one. We have good 20 or 30 new investors that came on board last year. So this stuff isn't difficult to follow.
And we have a question about how many different stocks that we're in the portfolio. We can tell that. In that sense, that it's not like we're invested in 400 different stocks. We tend to go how many?
The maximum we go for will be around 40. Now that can waver, that can change based on how successful the stock, everything's being. So if something, so in January, February, I think it was, we invested very early in Rheinmetall and several other defense stocks. Rheinmetall, I think, was our best performer this year so far, 176% up.
It's interesting. Pia just wrote at FOMO at mystockscanner.com. Let's jump to it. Let's bring up Rheinmetall then, since Pia wants to know. This is a current question. This one is tough for us how to answer that, because apart from if she should invest in it because she's seen it drop over the last couple of days, then second of all, what is the piece going to do? And the thing is that of course, we simply don't know. We can't answer that. We can look at Rheinmetall as a stock in our 3-point playbook. You can bring it up, Liam, and then we can take a look at it and kind of go, is now the time to invest in it? We have been in. You guys were in it for a long time, and you basically doubled your investment in that.
We were. We'll go through the playbook very quickly, and we'll go at speed this time, so you can see how quickly we can work on here. It helps, obviously, that most people know the stock at the moment. We also do have a view on what peace will do, and that's, as I say, from the macroeconomic side of things. That's what we look at. Is the defense industry as a whole a good place to be at the moment or not? And we can only see that by looking at what governments are doing around the world. So I'll cover that at the end. But from a company description point of view, it's a big defense company. It's based in Germany. That's where its home stock exchange is. From a quality point of view, again, everything is pretty much green, apart from the price to free cash flow. Current ratio is a little bit sort of low. We prefer it a little bit higher. That's just how much debt the company's got, what is net assets compared to its net liabilities, which gives you an idea of debt. But the interest coverage, which is how many times its profits can pay off its interest expenses, are high. So that's not a problem. So just looking at it, quality score of 88, earnings per share through the roof, PEG ratio 0.82, fantastic company. I'm hungry for more. I want to carry on looking. The returns are great as well. So yeah, okay, I'm happy with that. Question one, tick in the box. Let's just switch over to the valuations tab very quickly. And if I just rearrange, so most people when they come in, the system will be set to its default, which you can change it on here to say, how do you want it automatically presented? We give a little bit more background in this in the learning section, but these are my defaults that actually everyone gets on the system by when they join up for it, and that effectively tries to put these lines in the right place. And this is the job. This is the first learning curve that a lot of new guys coming in actually have to go through, is to try and work out where to put the red line. And basically, the red line, you should put it where the lowest points have been over time. So if we just get rid of the analysts quickly out of there, you can see that the lowest point for the stock over the last 2 years has been here, but actually going back, it's lower than that. It could even be back here. So this is where a little bit of judgment comes in to say, well, actually putting it here could be a good idea. You might even justify it being slightly higher. And the reason I would justify that is because we know that the European governments are going to shovel 2 trillion euros into their defense spending over the next 5 years. Therefore, this is a new world we're looking at. This isn't like the old world where Rheinmetall was a boring old defense manufacturer. This is an area where they're going to get an awful lot of money coming in, and they need to, they can make an awful lot of profits coming out of it. Similarly, with the green line, we can put it, the top here was this year. We can put it there. That's where the euphoria stopped, and investors started thinking, well, hang on a sec, are we going to make any money out of this? And the blue line, if you're not sure, it's either put it very close to where the analysts are, or if you've already got a line around there in the middle between the green and blue line. They're a good way of just initially setting this up to say, is this a good case that we've got? Are we being sensible?
A quick question, that is a general question in regards to buying stocks from Lasse, who writes, "Hey, you two, I noticed that a couple of times that that stocks you have bought have been when your own TPI as well as TradingView stock RSI is what's called overbought." Bring us quickly up, Liam. What does overbought mean in this situation?
Overbought means that it's basically too many people are buying the stock, and therefore you get certain stochastic averages, they're called, where they're basically lines. I'll quickly go into sort of
Yeah,
here and
yeah,
say,
yeah.
if we add a stochastic
And don't
into
worry,
here,
I can't do
don't
this
worry,
first
it's
time you
yeah,
you come in there. This is just something
yeah,
that Liam just put in here.
yeah.
But he also wants to know if we can ignore it.
Um, the answer is that depends, but the stochastic overbought and oversold is very obvious from this chart, where we can actually see this is just a mathematical set of averages for what the stock price has been doing. And you can see here that up here it's overbought, which means actually on balance is either going to go sideways for a while or it's going to start going down. That's what happens generally. And then it gets to an oversold position, and this is where we look at whether this is a good time to come in. So overbought generally means you avoid it, and oversold means that's the area we're looking at. Very similar to the green lines on the MTI. If we just look at the TPI very quickly here, we can see, we've got green for a trend. This is one of our indicators as well. It's a bit more about the turning points of a stock. You can see the green trend, so it's green here, which is good. You've got the weekly TPI, which again is green, and here you've got the daily TPI. So a triple green on the TPI is generally pretty good on here. And you can see the oversold and overbought markers to say the grey means that actually it's getting a bit toppy, and then the yellow down here means it's actually looking sort of quite overbought, so it might be a good time to look to buy. But on the Rheinmetall side of things, you can see, just from the playbook, we know it's got great value. We know it's a fantastic stock. It's dropped below it's 50. We sold it back around here. I think it was, no, it might have even been here. I can't. I should probably know this as well. I'll have a
Uh,
look in a sec. But
we'll
um,
forgive you as you go through a lot of
yeah,
stocks during the
so
day.
we sold it a while ago, and everyone said, "Well, hold on a sec, it's a great stock. So why there's so much upside?" But since we sold it, it has gone up a bit. It's always annoying to see these things bounce, but then it's come back down again. So it's trading in a range, and that is because people are looking at it thinking it's extremely expensive right now compared to where we got a load of money out of it recently, and we don't know when that money is going to come back. Here you can see it's committed sort of the two cardinal sins. It's dropped below its green 50, which means it's now in a downtrend. It's also dropped below its 200, which stocks often find it much more difficult to break the 200. That's often a bigger psychological barrier for people to invest past that than the 50-day. So that's going to take some doing to get back up. And I would suggest that that's probably going to carry on down a little bit, maybe. That would be my guess. We don't actually know.
No.
To be honest, I almost don't care, because I'm not married to this stock. If it goes up above its 250 day moving averages, we'll buy it. If it's not, we'll go and find something else to buy.
And again, as you said, I think that you have how many different stocks do we have in the system? 80,000, 90,000,
Yes,
something like that,
yes.
and that's ETFs as well. So there's plenty of stocks to go around, and we don't necessarily take the more sexy one. We take the more boring one that sort of churns out and make profits. I know that a lot of people have been asking, and a lot of people are worried about another stock. And I'm sorry if we're leaving Rheinmetall in a hurry. It has nothing to do with it being German or anything. But we're going to take one from good old red and white, and it might not be that green, because we're going to take a look at Novo Nordic, the big stock here in Denmark, of course, but also a lot of foreign investors have been into Novo Nordic. And Liam and Hans Henrik and you were also in this stock at one point, but you left it, and that's a different story. With
Yeah,
Novo Nordic, and different colors as we see right away here.
yeah, definitely. I mean, I'll go backwards on this one, actually.
Yeah.
We went into the stock around here. we actually looked at the whole stock. I'll just sort of get some more data up here. We looked at this drop that was somewhere around, well, back then it was 63%. And we looked at the fundamentals and we looked at the noises coming out of the market and actually said, this has gone green on the daily MTI. We know the data behind the system, so we can see the weekly was pretty close to going green as well. That could be a good entry point. The stock went up for a bit, came straight back down, broke its 50-day, we sold it. We also find one other thing here, it's called gaps. And you can see here that the stock, let's just move it around a bit. The stock's opened here in the green just above, and then the next day it opens down here, and there's a big gap between these two candles, 3% or so. In our testing of the 3-point playbook, because we've been developing this for the last couple of years, a gap almost always signified get out the stock. Sometimes you get a massive gap like this where you if you're in it, you lose.
Yeah, you have no time. There's no time to get out.
You can't get out. But with something like this, we've often found that the gap signifies a great time to get out. Even though you might be at a slight loss, it's better to get out now and not have the rest of the loss coming down here. So tends to signify not good times coming out. If we look at sort of going backwards, so that's 0.3, we'd stay away from the stock. It's below all of its averages. It's had a horrendous time recently. If I look at the company itself, is this the bottom? I've got no idea. We can't judge where this bottom is, so it's virtually impossible to actually say I would want to invest in this stock anytime soon, which is a real shame because it's a massive quality company with huge amounts of upside. But let's say that's it. So at the end of the day, we could lose 10% next year. We could be up 21%. So it's that's not a bad risk reward if we could had that feeling that it was going to happen. One thing we tend to do is we want the reward, the 21%, to be twice the risk. So we're basically loading the die in our favor, because if we go back to the portfolio, I'll just switch over to here. We go back to our portfolio, you can see that generally our win rate, which is this is the number of winners compared to the number of losers, and the win-loss ratio here, our win rate is hovering around 1. It's 50-50. It's just our winners are far better than our losers. So we're quite happy with that. We actually think in normal times this is going to go up to about 60-40%, something like that.
We're running out of time, but there's a couple. I want to take 2 more stocks, so I'll warn the people who are following us on our website or on Facebook or on YouTube that we will have a couple of minutes left, and also because I can tie in a question to one of the stocks that we went into. Let's not do more Novo, because in that sense that what you're also talking about here is trying to, in your language, catch a dropping knife. It's a stock going down. You're trying to catch it at the right time. We'd rather see a turn and then wait for it to see that it sustained that turn and then go up. And then we'll get into it. We might lose that bottom. But one of the stocks that we had, and this one is the sun going up, basically. It should have come down because we're talking First Solar here. It's one of the stocks that basically, if you look at the political trend, Trump became president in the United States. We knew all renewable, wind, solar, what have you, is not in his favor, but we bought it anyhow. The question that I'm trying to get to is from Alan, that wants to know that once we have bought a stock once, will we supplement in it? Will we ever buy more stocks than what we already have in that, or do we stay away from that? Is there a rule about that?
We don't. We just take that position and that's it. We have talked about on bigger increases like Rheinmetall, where we made 176%, or Saab, where we made only 140%. So it's almost not worth getting out of bed for, I know, but that those are sort of levels we got to with the defense stocks this year. We did talk about cutting down half of our position so that we still had the profits and we still had some skin in the game, but we took the profits and were able to actually invest that somewhere else. But we wouldn't necessarily double up in there, because there are so many other companies we want to go to, and diversification is one of the keys to why this system is safe for, we sleep well at night, because if one stock goes down, Novo Nordisk, it dropped 10% the other week. If we're only ever 2.5% of our cash in our investments in one stock, then a 10% drop is only 0.25% for our portfolio. So I can sleep through that.
Let's just quickly do First Solar. The reason why I want to show it is
Yeah.
because it's a little bit of a different story than Novo. First of all, you got in early, so you need to share the
Yep.
screen where you basically can show where you got in, and then we got out also. Maybe I won't say too late or something like that, because there is nothing like too late. But you, again, as you said, you can't be married to your stock. So in that sense, you just need to figure a place to get out once that you have it. But take us to First Solar and really quickly and go and see where we got in and out.
Yeah, I mean, First Solar, we're still in. We bought it on the 4th of August, and we're up 40%. From a 3-point playbook, we'll do this in 20 seconds. 81 score, earnings per share going up, PEG ratio great, everything else green. Fantastic companies. Price free cash flow currently is a little bit high, but it was lower when we bought it. It was almost a perfect company. From a valuation point of view, back in August, we were looking at the stock being somewhere, let's call it around here. And we can go back to August. We didn't pick it at the top. We don't buy things at the top. We never do. We won't come out of at the bottom. We won't come out of the top either. So we always come in a little bit late and we go out a little bit later, as you say. But you can see here, we were right at the bottom of the curve down here, and we could see all this growth going up there. So there was huge value in the company. We could see that. And then from the third point of the question, was it time to buy? Here we could see the stock just had great earnings. We don't buy within 2 weeks of earnings. Also, that's something we haven't mentioned so far. So we waited for the stock to go through earnings, waited for the market to sort out what it was doing with itself then, and whether investors still liked it or not. And we came in here, or here actually, and rode the wave all the way up. And the stock a few times has come down to almost touching distance to its 50, but then turned back up again, as you can see it did yesterday. So we're still in it. We're still in it for the.
And we haven't sold anything off that. We can share that. I'm going to bring up a new stock, because on Fridays in our show we broadcast every Monday, Wednesday, and Friday currently at noon. But on Friday we have a thing called the Face Off, where we pit two stocks against one another. And this is from Friday. And the reason why we bring it up, we're going to give you a stock that we went into just recently. And if you're Irish, you know that these two beer brands are probably not the one that you would pick, because the one is not Guinness.
Yeah,
so
exactly.
We took Carlsberg and we took Royal Unibrew and pit them against one another on Friday. And as a matter of fact, we ended up buying one of the stocks. We can declare that now, and we can tell that now. And it's not Carlsberg, even though that's the best beer in the world. Advertising.
No, it's not. I mean, you can see here, this is a lot more average from the playbook point of view. You can see it's still 60, but the earnings aren't particularly exciting. There's nothing going on there. Revenue's going up a bit. The analysts changed, not massively, but the stock's just a bit boring, to be honest. And then when you look at the valuations, they had a bit of a drop. So I'll go to earnings continuous, which is taking out the sale that they had, the corporate actions that they had. We can explain that in another webinar, but effectively it's a bit flat on the value side of things. There is a bit of upside here, 18% maybe, and a 9% downside. And the same goes for the stock itself. It's just above its 50-day. It's been meandering along for the last couple of months, 3 months. So there's nothing particularly exciting. The weekly MTI is in the red, and the daily's just gone in the green. So, okay, that's not enough to make me invest my money in here. If we move over to Royal Unibrew very quickly, we can see quality score is 88. Earnings are actually going up. The PEG ratio, a little bit high compared to where we'd want it to be. It was a little bit lower last week because we have got a few percentage points profit there. The analysts like it. The returns are okay. There's something I'll put up with if they're going down, if everything else looks good, free cash flow looks good, and so on. So not a bad position for the company to be in. Definitely much better than Carlsberg. Where the magic really happens here is on this chart, where we can see actually there is, if we hold it to next year, there's a 1% downside in the worst case scenario that we can see, and that's been tested a number of times over this year alone. So we're pretty confident that that's probably where it's going to go down to in the worst case.
And
And
as
we've got a
as Hans Henrik said during his analysis of it, was that every time it bottoms, it comes up again.
yeah.
And you can see that when you're going back over the years, it has a point. It seems like when it hits there, and he always says that's where the big elephants get into it. And it's not the Carlsberg elephants coming into the room, but
Yeah.
these are elephants, the big buyers of stocks. That's where they go in.
Yeah, that's exactly sort of where we try and follow in there. And just from a trading point of view, you can see, we went into it. Where did we go into Royal Unibrew? That was literally Friday, wasn't it? The 21st. So it had its big gap up, which is always a good sign as well. And we came into it on this green bar here, so we got into it around there, and we expect it to at least go up this far. Probably we're in it because we think it's going to go up more. In the worst case scenario, it drops down here to about there where the green line will be, and we'll come out of it.
Literally a green bar right
Yeah.
there, a bar, a pub it should have been. But anyways, Liam, I know this again. There's so much things that we can tell, and there's so many things and things that people want to know, and we don't get to all of it. But do write us at fomo@mystockscanner.com. Liam and Hans Henrik are really good at answering a lot of questions, much more than they really have time for, but they're going to do it. Go to our platform, go to mystockscanner.com, have a look around, play around. You can't break anything in there. It's basically a bar with no elephants. There's nothing to be broken in there. You can do whatever you want. And also keep an eye out for us on the social media on Facebook, and we will do a lot of articles, a lot of updates and stuff like that. And then I will say here finally at the end, tomorrow, have a look at your email, because of course it is the week that where the Americans get their turkey, and the rest of us, we get a lot of offers in the mail and out in shops and stuff like that. It's Black Friday, and we will have an email for you tomorrow with an offer that hopefully that some of us with Italian genes can say it's an offer you can't refuse. So you can hopefully have that. Liam, here towards the end, just before we go, we broadcast Monday, Wednesday, and Friday. We will be on tomorrow. In the market that is right now, I know we have a new tool coming up. We can't tell much about it, but it feels like we're going in a different direction. That we came from defense into AI, and there's a slight feeling that we're going in a new direction now. Am I right on that?
It does seem to be, and the work we're doing with this new tool that you're talking about is basically identifying where the trends of groups of stocks are going, and so far we've identified quite a few trends. One of them being in the brewing industry, which is how we came up with Unibrew and Carlsberg, and also one of our other stock picks from last week. So there are a few around there that we're currently interested in, and also the chemical side of things. So, I think, if things get that bad, it could be people are just reaching for the beer and the wine and the cider and deciding to forget about it in that way. But the chemical side is interesting. So, there does seem to be a bit of a shift, and it's mainly due to that power vacuum that says everyone's looking at AI, saying, where are we going to make money out of AI? And so, actually, let's take our cash somewhere and actually put it to use somewhere else.
Yeah. And I think that that's where people really, again, want also advice. Is one thing is to find the stock that you get into, but also get the advice on how to get out of them. And again, as I said, we try to teach people. That's what we want to do. We want to educate them and make them, because they have to buy the stocks on their own, so they have to take good decisions, and we try to help them do that. And as said, at mystockscanner.com. There's so many videos in there. There's so many webinars from earlier that you can take a look at, and that you can can learn from, for sure. Tomorrow, we will be back on air at noon at 12 o'clock Central European Time with our Wednesday show that, amongst other things, holds the Wednesday watch list, which is a result of the Tuesday poll, where we asked people today, what stocks are you looking for in Germany? And we will tell about that, and we will do an analysis of that. Liam Flavell, thank you so much for being here, and thanks for you guys for watching. Remember, send us emails, FOMO@mystockscanner.com. Articles and edits are on our pages, and we will be on air tomorrow. You guys take care. Thank you for watching. See you, Liam. Bye.